Welcome back, dear learners. In this module, this is our fourth module. In this module, we are going to discuss about international monetary system. Now, before entering into the discussion on international monetary system, can we have a recap of what is a monetary system? What are the different types of monetary system? Then let's discuss on the international arena. So tell me, my dear students, what is a monetary system? Yes, I think I got the answer as it's a set of policies, framework, and institutions by which government creates money in an economy. So there are three components to that. It is a set of policies, framework, and institutions involved in creating and using money in an economy. So the institutions can be central bank, treasury, financial institutions. All this will come under the category of institutions. And when we look into the common types of monetary system, we can say there are three. One, commodity money. Two, commodity-based money. And three, fiat money, the present system. Let's discuss what is a commodity money. As the name indicates, in case of commodity money, it is made up of precious metals or other commodities that have some sort of intrinsic value. That is, the commodity is having some value of its own. Can you see an example for it? Yes, gold. So here the monetary system uses commodity physically in terms of currency. Imagine you have to carry 1 kg of gold for buying something. It's not literally possible. You cannot imagine. It was there at some point of time. The commodity money was the monetary system. Now we may not be able to think of such a system. Right. Now the second one which was very popular is commodity based money. As the name indicates, here you have both commodity and money. That is money backed up by some commodity. In other words, this system draws its value from a commodity but does not involve handling the commodity regularly. You do not have to carry the commodity, but the value of the money in your hand is determined by some commodity. Maybe gold, maybe silver, depending on the situation. So that is commodity based money. The third one, which we are very much aware of it, is fiat money. In this monetary system, the value of the currency is guaranteed by the respective government. So the government is entrusted with the value of currency as well as currency management. So this is the most common type of monetary system in the world. This about the monetary system. So monetary system is a set of policies, frameworks, and institutions by which money is managed in an economy. If that is the case, we are just straight away applying this to the international arena. That is, an international monetary system is a set of internationally agreed rules, conventions, and supporting institutions that facilitate international trade, cross-border investments, and maybe reallocation of capital between the nations. So here, there is no change. The change remains in the application of these rules, policies, and framework. Application is not limited to the national boundary, but it is taken to the international level. Okay? So this is the background for discussion of our module on international monetary system. Are you there with me? Can we move further? Right. Now just look at the agenda, what we will be having. We will be discussing on international monetary system as well as players involved in that. We also discuss about a foreign exchange market, foreign currency accounts, methods of making international payments. Then we discuss some of the foreign exchange rate theories, popular theories, and the most important thing, concept of balance of payment. So this is our agenda for fourth module. Let's go into a detailed discussion. As I said, international monetary system is a system that forms rules and standards for facilitating international trade among the nations. So here, this is actually a result. This is actually an output. It helps in reallocating the capital and investment from one nation to another. The flow of or the movement of fund, maybe from the savers to the investors, right? So that is happening not only in the national boundary. Here, international monetary system facilitate it through the international boundaries, right? So the main function here is, so when we promote growth, when we promote more development opportunities, naturally it will help in reducing the global poverty, because some of the nations would be having some difficulty in obtaining necessary financial resources. In contrast, some may be having plenty of resources but less investment opportunities. So they can share their resources. One is sharing the financial resource, other is sharing the investment opportunities. Right. So this can be done, which ultimately will result in reducing global poverty. And of course, when you can move across the boundaries, when there is a stable monetary system, when there is a clarity regarding how payments to be made, how payments to be, what is a rule regarding the exchange rate, foreign exchange rate, then naturally, if that clarity is there, if there is a system, it will promote international trade. And ultimately, when you have a system, this is the net result. It will promote financial stability as well as economic development of the world economies. Economic development is actually the result of all these activities: increased trade of goods and services, better investment opportunities, better return for your investments. All this lead to economic development of your nation. So this is the main function that has been rendered by international monetaries, a stable international monetary system. Right. This is the significance of this topic from the perspective of international finance. Okay, so can we move forward? Now we will discuss about the history of international monetary system. In order to understand the history in a better way, we need to have a clear understanding of what is fixed exchange rate system, floating exchange rate system, and managed floating rate system. Some of you might be knowing this, but we will have a short discussion on what is this all about. Let's start with exchange rate regime. Now, exchange rate regime is the way a monetary authority of a country or currency union manages the currency in relation to other currency. So it's actually managing the movement of one country's currency with other countries, as well as it involves the foreign exchange market. So, exchange rate regime is a system that looks into the movement of currency in relation to other nations' currencies. It includes foreign exchange risk management. When we look from a global perspective, there are three basic types of exchange rate system or regime. One is floating exchange rate system. Two is fixed exchange rate system. And three is managed floating rate system. It will be easy for us to start the discussion with fixed exchange rate system. Fixed exchange rate system is otherwise called as pegged exchange rate. And this is a type of exchange rate system in which a currency's value, listen to me very carefully, in which a currency's value is fixed or pegged by a monetary authority against the value of another currency or a basket of other currencies or any other measure of value, maybe metal such as gold. So here the value of a currency is pegged, is fixed on the value of something other than that. For example, a currency which is pegged to gold. Value of a currency is decided based on the value of gold. That's a fixed system. Or it can be a basket of currencies. Normally, when we talk from the perspective of international market, the reserve currencies are US dollar, euro, British pound, sterling, Swiss franc, and the Japanese yen. So this can be the basket of currencies. These are considered to be the most stable currency which are acceptable across the global economy. So that can be the basis. So for example, if you look into, there are 4 countries across the globe that maintain a fixed rate system for a basket of currencies. These countries, these 4 current countries are Fiji, Kuwait, Morocco, and Libya. They look into the basket of currencies and they peg the value of their currency to that basket. So that the value of the currency of these 4 countries are not limited to the value of one single currency, or their currency do not have a value to themselves, but it is pegged to another. That another factor here is for a basket of currencies. Right. So that system is what we call as fixed exchange rate system. So the movement of the value of currencies of these 4 countries depended totally on the basket of currencies or the movement of value of currencies in the basket. So there is no other force of demand or supply, nothing like that. It is controlled by the value of those currencies in the pegged basket. Right. So that system is what we call as exchange rate system. Now next we are going to discuss about floating exchange rate system. Here it's just the opposite. The currency price of a nation is set by the forex market based on supply and demand relative to the currencies. Supply and demand were relative mainly to other currencies. Because if there is a heavy demand for dollar and less demand for rupee, naturally rupee value will depreciate against dollar. Or in other words, if we say in the reverse order, dollar value will definitely appreciate in the foreign market. So that is what here in case of floating exchange rate regime or system, where the currency price of a nation is set by the forex market on supply and demand. This is just a contrast to our fixed exchange rate, in which the government entirely or predominantly determines the rate based on the pegged asset or pegged currency, or to whatever asset the currency is pegged with. Right. So this is all about floating exchange rate system. Now can we discuss about the managed floating rate system? Managed floating rate system is very much similar to floating exchange rate system, but there is slight difference. We follow, in India we follow managed floating exchange rate system. Here the government or the country's central bank may occasionally intervene in order to direct the country's country's currency value into a certain direction. Otherwise, it is left to the forces of demand and supply. But in urgent situation or in a situation which demands some kind of intervention in order to regulate the movement, There, the central bank or the government will intervene to regulate the currency movement. This is generally done in order to act as a buffer against economic shocks and thereby softening the impact, the negative impact on the economy. Suppose if there is a global financial crisis, maybe the currency of a particular country will be very much affected by the crisis across the global economies. So the government, along with central bank, may intervene to regulate the movement of that currency, either by if there is a liquidity crunch, then automatically more currency will be brought into the market, or if there is plenty of currency in the market to create no artificial shortage, maybe some currency will be pulled out of the market. So likewise, managed float exchange rate system is a exchange rate system in which the government or the country's central bank may occasionally intervene in order to direct the country's currency value into certain direction. Normally it is for a positive outcome. It is actually the halfway between the fixed rate system and the floating exchange rate system. See, for example, if a currency's value increases or decreases too rapidly, you know the kind of economic impact that is going to happen in the country's different industries. Right. So the central bank may decide to intervene in order to minimize any harmful effects of that might result from otherwise the radical fluctuation. So if there is a radical fluctuation, the entire economy is going to be affected. So in order to avoid that, the central bank may immediately intervene to minimize the harmful effects. Such type of exchange rate system is what we call as managed floating rate system. So here, this is fixed on the value of another currency or a basket of currency or any other metal or valuable asset, pegged. It is fixed. Here, it's left to the forces of market. Here also, it is left to the forces of demand and supply, but with control in case of any need, but little intervention in case if the situation requires. Right, that is managed floating. We are having this managed floating rate system from 1994 onwards. India is having this system from 1994 onwards. Right. In this background, we are going to discuss about the history of international monetary system. Right. You might have heard the recent news that the Chinese government, they have decided to cancel the dollar peg in stock exchange transactions and decided to officially link to Chinese yuan instead of dollar. It has surprised the world economy because this means that the dollar has become non-existent in Chinese trading and the US dollar will fall shortly, fall strongly against the Chinese yuan, and this can affect the global markets. So this is all connected with the international monetary system. Okay, now let's continue with our discussion. See, basically, when we look into the history of international monetary system, there are four phases. There are four phases. The first phase, I put in this order, the chronological order itself. You can see in this graph. The first phase is the gold standard. This is from 1875 to 1940. Then we have an interwar period. This was from 1915 to 1944. And then Bretton Woods system, which is very popular, that came into existence. That was from 1945 to 1972. And then the current system, which has evolved over the years. It started from 1972. So likewise, we have four phases. Coming to the first one. See, as the name indicates, the gold standard is a monetary system in which each country fixes the value of its currency in terms of gold. Right? You're right, gold, because this name itself indicates that. The exchange rate is determined accordingly. So if it has fixed its value of currency in terms of gold means, naturally the exchange rate also will be determined based on that. I'll tell an example for this. Say, for example, 1 ounce of gold is equal to 20 pounds. This is normally fixed by UK. Same like this, US also can fix 1 ounce of gold is equal to $10. In that case, the dollar pound exchange rate will be, learners, can you guess? I repeat, 1 ounce of gold is equal to 20 pounds. That's fixed by UK. As against it, 1 ounce of gold is equal to $10. That's fixed during the same period by US, United States of America. So can you just guess what would be the dollar pound exchange rate? I hope you guessed it right. It is 20 pounds is equal to $10. There's no mathematics. It's clear. Again, which can be said as 1 pound is equal to $0.5. So this was fixed exchange rate system during the gold. It was pegged against gold standard. So that's why it said this was fixed exchange rate system, and there was free convertibility between gold and national currencies. Since it is pegged to gold, there is free convertibility. I hope this stage is very clear. So the value of currency was fixed in terms of gold. So the exchange rate system prevailing was fixed exchange rate system. Right? We are going to the next one. The next one is interwar period, because this was during the World War period. This system evolved during the World War period. After the World War started in 1914, the gold standard was almost abandoned because the countries could not manage it. Right. And they began to depreciate their currencies in order to export more. So the system prevailing was fluctuating exchange rate system. They left it to the demand and supply, as well as they also intervened either to depreciate or appreciate the value of currency. At that time, it was normally to depreciate because many of the economies were facing financial crisis. So many of them depreciated their currency in order to export more, or for promoting more exports from their country, because exports are expected to earn revenue. Right. So that is in between. It was from 1915 to 1944. Then came the most prominent system, which was otherwise called as dollarism, the Bretton Woods system. The Bretton Woods system was almost based on dollar as fixed exchange rate. In other words, in order to rebuild the world economy after the destruction of the two world wars, the new international monetary system that was established in 1944 in a conference organized by United Nations. And here it is noteworthy that it was organized, the conference was organized in a town named Bretton Woods in USA. Hence, it is called Bretton Woods Conference, and the system is called as Bretton Woods system. It was attended by almost 44 countries, and India also had a representation to that. And Sir C.D. Deshmukh, the first Indian RBI governor, represented India for that meeting. And in the Bretton Woods Conference, there was a new monetary system which was created, which is called as the Bretton Woods system. And basically, it was a dollar-based fixed exchange rate system. Here, only the US fixed the value of its currency to gold. Only US had the right to fix the value of its currency to gold. The other currencies were pegged to US dollar and were allowed to have a around about 1% band around which their currency could fluctuate. So they were asked to fix a value considering the value to US dollar. And US fixed the value of the dollar to gold. So the initial peg was $35 is equal to 1 ounce of gold. That was the initial pegged value at that time. In 1945, $35 is equal to its worth for buying 1 ounce of gold. That was the peg. value. And all other currencies were pegged to dollars, US dollar, not to gold. Remember, it was not to gold, it was to dollar. And they were allowed to fluctuate between almost 1% in plus or minus. And of course, because it was a crisis period, countries were also given the flexibility to devaluate their currencies in case if they have some emergency, they were allowed. But broadly, there it was a period of dollarism. The currency value was fixed based on the dollar value, right? So that is Bretton Woods system. So the system was evolved in the Bretton Woods Conference in USA. It was in 1944. So it is a dollar-based fixed exchange rate system. We again moved back to a fixed exchange rate system. Okay, now the next stage. Now the next stage came up with the collapse of Bretton Woods system in 1971. The Bretton Woods systems almost collapsed, and people were finding it very difficult to peg against dollar. So by 1973, the world moved again to the flexible exchange rate system. And over the period, again, some of the nations went with managed flexible rate system or managed floating rate system. That is, the currency value is normally determined based on the movement of demand and supply, and the government or the central bank can intervene if some situation requires that. That's actually managed floating rate system. As I already said, India went with the managed floating rate system, in which the exchange rates fluctuates from day to day, but central bank intervenes by buying and selling currencies to maintain a certain range. That is happening in India now. But at that time also, after the Bretton Woods, after the adoption of floating rate exchange system, many of the nations still stuck to the dollarization. That is, process of aligning the country's currency with the US dollar. Many of the countries, world nations, again stuck to dollarization. That is, they wanted to peg against the US dollar, even though countries like India, China all adopted managed floating rate system. Okay. Now, that's about the major 4 phases or stages of history of international monetary system. So the first phase was gold standard, then came gold standard was fixed exchange rate system, then came the fluctuating exchange rate system, where the country had freedom to decide the value of the currency based on the demand and supply. And then again it was pegged to dollar. The currency only US pegged to gold. All other currencies across the nation were pegged to US dollar. The system collapsed by 1973, and we came up with another system, or we went back again to the fluctuating, or as you call as floating exchange rate system. And today, countries like China, India, and many other nations, US, all follow managed floating rate system. And today we came to know, in this week we came to know about the news. Yes, China also removed the pegged dollar system from the stock exchange. They are linking that directly to the floating rate system, that is Chinese yuan. So that there also they have went with the floating rate exchange rate system. Okay, in between, I would like to mention about European monetary system. You might have heard about the common currency euro. So let's have a small discussion on what is European monetary system. The European monetary system was initiated in 1979. That is somewhere during this period, when Bretton Woods collapsed, when the world was looking towards another monetary system. There, European countries went with European monetary system by an arrangement of member states of European Economic Community. That's why it is called as European monetary system. and it was succeeded by the Economic and Monetary Union of the European Union, EMU, which was established in 1992. Even though it came into existence by 1979, the current phase evolved in 1992 under Economic and Monetary Union of European Union. And EMU represented a major step of integration in the European Union economies, and founded a common currency called euro. Even though they are facing a lot of crisis during the last few years, they established a common currency for European Union economies, that was euro. And EMU aimed at establishing an exchange rate mechanism to reduce the exchange rate variability between the European economies, and also to achieve a monetary stability in euro. That was the basic intention. Every nation have an exchange rate system which aims at bringing a stability in the monetary system in the international market. Here also, EMU was established with a specific focus on European economies. We have heard recently about Brexit, where Britain came out of that. All these we have read, we have discussed in the class also. So the basic idea of EMU was to reduce the exchange rate variability and to achieve a monetary stability in Europe. So that's it about the history of international monetary system. It is really interesting to know. We have discussed only the major points. We have only discussed the milestones in the history of monetary system, but please do extra reading to understand that in a detailed way, right? Now we are going to the next part, that is foreign exchange market. Now, can you guess what is foreign exchange market, or what is the role of this foreign exchange market? Can you guess? I hope you have said that as the foreign exchange market aim at bringing a better trading platforms, right? It helps in economic development. It helps in creating cooperation between different countries across the globe. It helps in better exchange risk management, right? I hope you have said all these. You're right. Now let's discuss what is really a foreign exchange market. In fact, it is a place, I put it here, it is a place where currencies of different countries are traded or exchanged. You cannot point out a place. It's actually wherever there is an exchange of currency happens, that is said to be a foreign exchange market. It can be between financial institutions, it can happen in the stock markets, it can happen between private parties through import and exports. All this are said to happen in a foreign exchange market. Now, as we know, foreign exchange market is very dynamic. It's a dynamic global market because it helps in the exchange of currencies among the countries involved in international trade. Different categories of currencies, different denominations, different value. It is not restricted to geographical boundaries of any nation. So that's why the market is very dynamic. And it is also set to operate 24-hour market, because here the exchange or conversion of currencies of countries is taken place along with movement of clock in a day of 24 hours without any interruption except on maybe weekends. It's a continuous market. You go with the conversion for maybe the requirement is different or the purpose may be different, but the market is very dynamic and it continues throughout the period. And of course, if we are talking about a system, The requirement, the basic requirement of a system is transparency. So that is there in a foreign exchange market. Transparency in price is one of the key characteristics of a forensic market. And it got significantly enhanced with the introduction of online trading of currencies and foreign exchange. I can sit in my home and then see what is the price of dollar in the international market. Or I can look at what price in the Indian rupee is trading in the market. So it is very much transparent, especially through online trading mechanism. That again is another important feature or requirement. In fact, it is a requirement of a system, transparency in the dealing. And as you know, it's a global network. It is international network of forex dealers and mainly financial institutions. Individual investors and players are very limited. It's actually a network of institutions and forex dealers. That's why we say that it is a global network. And I already said it's an online market, over the counter. Foreign exchange market is otherwise called as over the counter market due to its operation. It does not require any specific place or floor area, but transactions are carried out throughout the online platforms. We know that, we have seen that, right? So these are the key features of foreign exchange market, which makes the system perfect. It's evolving. Over the years, it has only improved. So maybe in future also that's going to be improved in a different way with the presence of cryptocurrencies. There are many changes that are coming in the financial market, which will be reflected in the foreign market also, right? So that's an introduction to the foreign exchange market. And there are broadly two types of market. Foreign exchange market, when we look from the perspective, there are broadly two types of market. One is the spot market. Spot is nothing but, what do you mean by spot? Spot is the present, the kind trading of currencies is made immediately at the existing rate on the date of transaction. That's a spot, the present market. When you look into the stock market, when you look into what is the exchange of Indian rupee today, exchange against dollar, that's a spot market. And when we talk about a forward market, this is just the opposite of a spot market. It is timing of delivery of the underlying asset on a future date. You may enter into a contract to sell the dollar, but definitely it is not for today. It might be after 1 month. You will quote the price today. After 1 month, at what price you are ready to sell your basket of dollar? Maybe you are telling, I'm ready to sell $100 against rupee, right? For so and so rate on a future date. Definitely the time is future. That's a basic difference between a spot market and a forward market. You enter into a contract to exercise. It can be buying also. You exercise an order at a future date. That's a forward market. So the type of market or the kinds of foreign exchange market can be spot market or a forward market. Here you have got, we broadly talk about this as a derivative instrument, derivative market. Here it happens in a spot market. Stock exchange, you have, when you look into a stock exchange, you have two types. You can buy share today, or you can enter into a derivative option or derivative market, and you can place an order for purchasing a share in future. Maybe an option. It can be through an option. Right. So that is what we call as a forward market. So there are two types of foreign exchange market. And the next what I have, the next what I have put here is exchange rate quotations. Exchange rate quotations means the rate or how you quote the price of a currency in an exchange. How you quote the price of a currency as against other. That's what you call as exchange rate quotation. Say how you quote rupee against dollar. How you quote dollar against yen. That is quotation. You are quoting the rate. At what rate you are ready to supply dollar if the other currency is rupee. That's what we call as exchange rate quotations. And there are two popular types of exchange rate quotation. One is direct quotation and second one is indirect quotation. Okay. Now, in case of direct quotation, when we talk about direct quotation, here the price of one unit, listen to me very carefully, the price of one unit of currency, one unit of foreign currency is expressed in terms of domestic currency. That is, the price of one unit of foreign currency is expressed in terms of domestic currency in case of direct quotation. Can you think about an example? Okay, we will try to quote the most popular or familiar one is US to, which we often use, US to Indian rupee. So what you have to understand here is in direct quotation, the foreign currency is the base currency and the domestic currency is expressed in terms of foreign currency. Right? So we are trying to see how direct quotation is made if the two currencies involved is US dollar and Indian rupee. So US dollar is a foreign currency to us, Indian rupee is a domestic currency. In that case, we will express indirect quotation as 1 US dollar is equal to 76.60 Indian rupee. So we have expressed rupee quoting dollar as the base. $1 is equal to 76.60 Indian rupee. That's an example of direct quotation. It's very simple. It's very clear. Here the base currency is foreign currency. I hope you are clear with that. Can we move further? Okay. The next we have to explain about indirect quotation. If direct quotation base currency is foreign currency, in indirect quotation it's just a reverse. Right. Here the base currency will be domestic currency and foreign currency is expressed in terms of that. So naturally it would be Indian rupee to US dollar. So 1 Indian rupee is equal to 0.013 US dollar. That's an example of indirect quotation. I repeat, 1 Indian rupee, that's a base. 1 Indian rupee is equal to 0.013 US dollar. That's an example of indirect quotation. So naturally, a lower exchange rate in a direct quote implies that the domestic currency is, yes, domestic currency is appreciating in its value. Whereas a lower exchange rate in indirect quote indicates that domestic currency is depreciating in value. Correct? A lower exchange rate. So if I say that 1 US dollar, I can get 1 US dollar by spending 50 rupees. It is a better position than getting $1 for US dollar for 76.60 Indian rupee, right? That's why we say that if the lower exchange rate in a direct quote implies, earlier example which we discussed was 1 US dollar is equal to 76.60 Indian rupee. In this case, I'm just telling 1 US dollar, it's imaginative, okay? 1 US dollar is equal to 50 Indian rupees. It's a lower exchange rate, which means your domestic currency is appreciating in the value. I hope you are there with me, right? So that's all about exchange rate quotations.